The morning banks lock their doors never announces itself with sirens, headlines, or visible panic. People wake expecting coffee, errands, payroll deposits, and routine access to money they assume is theirs. Instead, they find polite signs, limited withdrawals, technical issues, and vague promises to return tomorrow. By the time tomorrow arrives, access has already shifted from right to privilege. Bank freezes rarely begin with chaos. They begin with paperwork, emergency clauses, and legal authority quietly activated. Modern banking systems are not designed to guarantee access, but to preserve institutional stability under stress. When survival is threatened, protecting banks becomes priority, while depositors are expected to wait patiently. Waiting, in financial crises, is rarely neutral. Most people believe a bank balance represents stored money sitting safely until demanded without conditions. In reality, a deposit represents a legal claim against the bank, not segregated cash held for safekeeping. The moment money enters a bank, ownership changes, even if apps and statements hide this truth. You stop being an owner and become an unsecured creditor overnight. This is not theory, speculation, or conspiracy. It is basic contract law embedded inside every account agreement nobody reads carefully. Deposits are legally loans made to banks, repayable under normal conditions, not guaranteed in emergencies. Under stress, repayment timing becomes negotiable. History shows exactly how fast this distinction becomes painfully real during systemic panic. In 1933, American banks collapsed in waves as depositors rushed to withdraw their savings simultaneously. President Roosevelt responded by freezing the entire banking system through a nationwide bank holiday. Withdrawals were banned, accounts locked, and access suspended without individual court orders. Americans could not reach their own money for days, regardless of rent, food, or medical emergencies. The goal was not fairness. It was stopping collapse by removing access itself. Trust was sacrificed temporarily so institutions could survive long enough to reopen. The lesson was clear. Access exists only when systems allow it. Deposit insurance was later introduced not to guarantee liquidity, but to reduce panic psychologically. Confidence, not cash availability, became the cornerstone of banking stability afterward. People learned to trust guarantees, not doors. Decades later, Cyprus repeated this lesson in a quieter, more technical way. After banking losses, deposits above insurance limits were seized through legally sanctioned bail-ins. Customers became involuntary shareholders in failed banks, losing access but not legality. Money was not stolen, it was converted. The European Union later normalized bail-ins as official crisis resolution policy. Depositors were formally ranked behind system stability, not above it. What once shocked became procedure. Lebanon showed how freezes work, even without formal declarations or transparent legislation. Banks imposed withdrawal limits, currency controls, and selective access while denying official capital controls existed. Courts offered no relief, and regulators blamed circumstances beyond control. Depositors were trapped without legal recourse. Savings lost over 90% of value as currency collapsed under frozen access conditions. Middle class Professionals rationed cash weekly, while balances remained visible but unreachable. No revolution occurred, only quiet compliance enforced by legality. These events are not foreign anomalies. They reveal how modern banking functions everywhere under pressure. The United States follows the same hierarchy, though wrapped in stronger institutions and better messaging. During 2008, governments worldwide tested withdrawal restrictions and emergency liquidity controls discreetly. Iceland froze accounts, Greece capped withdrawals, Argentina locked deposits entirely. Each case followed the same script: stability justified suspension, legality replaced consent. Depositors absorbed pain so systems could breathe. In 2023, Silicon Valley Bank collapse exposed this truth again for American depositors. Uninsured deposits were frozen instantly, pending regulatory decisions rather than depositor rights. Access returned only because authorities chose intervention, not because contracts demanded it. Different choices would have remained legal. This reveals the core structure hidden beneath everyday banking convenience. Banking is not about ownership. It is about hierarchy during stress. Someone must absorb losses when systems strain, and depositors are never first protected. They rank behind equity holders, bondholders, and institutional stability. Normal times hide this hierarchy behind apps, ATMs, and instant transfers. Crisis removes the illusion and reveals structure. Access to money is not a constitutional right. It is conditional infrastructure. Infrastructure fails when overloaded. The justification for freezes never changes: prevent panic, protect markets, buy time. Time is bought for institutions, not households. When withdrawals stop, banks stabilize, markets calm, and regulators gain breathing room. Households, meanwhile, lose agency silently. The danger lies in how little warning exists before access disappears. There is no legal requirement to notify depositors ahead of freezes. Emergency powers override contracts instantly when risk thresholds are crossed. By the time rumors spread, control has already replaced access. This is not malfunction. IT design. Modern banking survives only if most people do not demand their money simultaneously. Confidence keeps the machine running. Fear shuts it down. When fear spreads, legality steps in to enforce order. And legality always favors systems over individuals. Because laws are written to preserve structures, not savings. By the time depositors understand this, the language changes around them. It's stopped by money systemic risk. Systemic risk always wins. Banks do not break laws when they lock doors. They follow the rules written precisely for that moment. And those rules were never written for you. When depositors challenge freezes in court, they discover the law rarely stands on their side. Judges are not asked whether freezes feel fair, but whether authorities acted within emergency powers. Emergency powers are written broadly, intentionally vague, and triggered by financial stability threats. Once invoked, individual rights yield to systemic preservation almost automatically. Courts consistently rule that preventing collapse outweighs temporary deprivation of depositor access. Money delayed, restricted, or converted is framed as regulation, not unlawful seizure. Depositors are reminded They accepted contractual risk when opening accounts. Consent was signed long before crisis arrived. In legal terms, a bank failure is treated as a public emergency, not a private dispute. That distinction removes many constitutional protections people assume still apply. Property rights weaken during declared financial emergencies. Access becomes conditional on policy goals. This explains why lawsuits after freezes almost always fail or drag on uselessly. By the time rulings arrive, damage is already permanent. Legal victory without liquidity is meaningless. Governments justify freezes using one phrase repeatedly, maintaining orderly markets. Orderly markets require slowing exits, controlling capital flight, and stabilizing balance sheets. Freezing deposits achieves all three simultaneously. Depositors become involuntary shock absorbers. Central banks play a crucial role in this process. They provide liquidity to institutions, not individuals. Banks receive emergency funding while customers receive restrictions. This asymmetry is structural, not accidental. The logic is ruthless but consistent. Saving the institution preserves the system. Saving depositors individually does not. Deposit insurance is often misunderstood at this stage. Insurance guarantees eventual repayment, not immediate access. During freezes, insured funds may still be temporarily inaccessible. Insurance calms panic, but does not unlock doors. Even insured depositors can face withdrawal limits, transferban, and payment delay. Coverage protects value, not timing. Timing is survival. The future of banking does not reduce these risks. It intensifies them. Digital banking allows freezes to be enforced instantly and universally. No physical branches are required. No visible lines warn others. Access disappears silently with code. Central bank digital currencies would increase this control further. Programmable money allows restrictions by amount, location, time, or purpose. Policy could be enforced directly at wallet level. Compliance replaces discretion. Supporters call this efficiency. Critics call it surveillance. Legally, it remains control. As cash disappears, exits narrow. When everything is digital, everything is stoppable. Freezes no longer require emergency declarations. They require permissions. This does not mean collapse is inevitable. It means hierarchy is unavoidable. Those who understand this prepare differently. They do not assume banks are vaults. They treat them as utilities with failure modes. Historically, wealth that survive freezes come characteristics. It avoids single jurisdictions. It avoids sole reliance on banking access. It prioritizes optionality. Liquidity outside the system matters. So does diversification across institutions, assets, and legal structures. No single solution is permanent. Resilience comes from layers. Real assets behave differently than claims. Productive skills behave differently than balances. Mobility matters when access is restricted. The most dangerous belief is assuming it cannot happen here. Every country that froze deposits once believed that. Stability always feels permanent until the moment it isn't. Banking crises rarely announce themselves loudly. They begin quietly, then suddenly become irreversible. By the time certainty arrives, choices are gone. This is why understanding legal structure matters more than optimism. The law tells you what happens when comfort disappears. And the law is clear. When banks lock the doors, they are not breaking promises. They are enforcing priorities. The system survives by sacrificing access. Access survives only when systems are calm. That is the trade modern banking makes. If this story gave you a new way to see history, subscribe. Because understanding power is the first step toward surviving it.